There's a warning signal flashing in the S&P 500 that most investors are completely missing, and it's identical to what happened just before the dot-com crash. Looking at the performance data, the S&P 500 has delivered 86% total returns over 3 years, while the equal weight version has only gained 43%, a performance gap we've seen exactly once before in modern market history. When you examine institutional positioning and historical market patterns, we're witnessing the same dangerous concentration that preceded the 1999 bubble burst. NVIDIA alone now represents over 7% of the entire S&P 500, while Apple and Microsoft combine for another 13%. That's 3 companies controlling 20% of America's stock market benchmark. The wealth preservation opportunity here is massive because most retail investors are making the exact same mistake they made in 1999, assuming that what's working today will work tomorrow. I'm about to show you the specific data patterns and institutional strategies that separate survivors from casualties when concentration unwinds. Breaking down the current market concentration reveals why parallel to 1999 should concern every investor. The top 10 stocks in the S&P 500 now represent over 35% of the index weight, compared to just 20% in 2020. When you look at March 1999, we hit 34% concentration just before the dot-com correction began. What emerges from analyzing market structure is that we're experiencing winner-take-all dynamics driven by the AI supercycle, similar to how internet hype drove 1999 concentration. Real portfolio data shows that investors holding broad market ETFs are unknowingly making massive concentrated bets on just a handful of mega-cap technology companies. The market psychology insight here explains why happens repeatedly. Success breeds overconfidence. Overconfidence breeds concentration, and concentration breeds vulnerability. The market doesn't care about your conviction when trends reverse. It cares about your risk management. Analyzing the specific parallels between 1999 and 2026 reveals an almost identical playbook unfolding in real time. In 1999, technology companies like Cisco, Intel, and Microsoft commanded extreme valuations while traditional value stocks were ignored. Today, NVIDIA trades at 65x earnings, Tesla at 45x, while financial stocks trade at 12x earnings. Looking at the Federal Reserve positioning, we see another crucial parallel. In 1999, Alan Greenspan was transitioning from accommodative to restrictive policy just as market concentration peaked. Today, with Kevin Warsh nominated as the new Fed chair and rate cut expectations diminishing from 6 cuts to potentially 0, we're seeing similar monetary policy uncertainty. What emerges from studying both periods is that concentration risk amplifies volatility in both directions. The same momentum that drives NVIDIA up 240% in 2023 becomes the force that could drive it down 70% during corrections, creating systematic risk that most investors fail to recognize until portfolios are decimated. Understanding the current AI capital expenditure surge reveals why concentration may be more dangerous than 1999. Microsoft spent $14.9 billion on AI infrastructure in Q4 alone, while Google spent $11.2 billion. Combined, the megacaps are spending over $200 billion annually on AI infrastructure with unclear return timelines. What distinguishes current AI spending from sustainable technology investment involves analyzing return on invested capital patterns. Unlike 1999's internet infrastructure that eventually proved valuable, current AI spending resembles the fiber optic build-out that destroyed shareholder value for years. The institutional analysis shows that smart money is becoming increasingly cautious about AI Capex sustainability. While retail investors chase NVIDIA momentum, BlackRock reduced technology exposure by 15% in Q4 2025, while Vanguard increased value sector allocations to 20-year highs. Examining how Federal Reserve policy uncertainty amplifies concentration risk reveals why the current environment is particularly dangerous. Market pricing shows only a 5% probability of rate cuts in March 2026, down from 85% expectations in December, creating uncertainty that historically triggers concentration unwinding. What the data reveals about concentration during policy transitions is that megacap stocks become more volatile as investors reassess growth assumptions under different rate environments. When the 10-year Treasury yield jumps from 3.8% to 4.5%, NVIDIA's 65x P/E ratio becomes mathematically unsustainable. The wealth preservation insight here addresses the biggest risk facing concentrated portfolios. Duration sensitivity increases exponentially with concentration. A 1% increase in interest rates historically reduces high-valuation growth stocks by 15 to 25%, while value stocks typically decline only 5 to 8%. Tracking institutional positioning reveals how smart money is preparing differently for potential concentration unwinding compared to 1999. Bank of America's institutional flow data shows large institutions moved $45 billion out of megacap technology while building $28 billion in value positions during Q4 2025. Looking at 13F filings from major hedge funds and pension funds, we see strategic diversification away from concentration risk through international exposure, value rotation, and alternative asset allocation. Ray Dalio increased international exposure to 35%, while Warren Buffett's Berkshire increased financial sector holdings to decade highs. The behavioral finance advantage of following smart money positioning involves understanding that institutional investors learned from 1999 and are applying those lessons proactively. While retail investors chase NVIDIA's latest earnings beat, institutions are building defensive positions before concentration becomes problematic. Implementing equal weight strategies as concentration hedge reveals significant opportunities that most investors are missing. The S&P 500 Equal Weight ETF, RSP, has underperformed the cap-weighted index by 43 percentage points over 3 years, creating the largest valuation gap since March 1999. What emerges from analyzing equal weight performance during concentration periods is that the underperformance becomes opportunity when concentration unwinds. Historical data shows that RSP outperformed SPY by 25% during 2000 to 2002 and by 18% during 2007 to 2009 when concentration reversed. The practical wealth creation approach involves systematic rebalancing toward equal weight exposure before concentration reversal begins. At current valuations, RSP trades at 18x earnings versus SPY's 24x earnings, suggesting 30% relative upside when mean reversion occurs. Understanding how international markets provide concentration hedging reveals why global diversification is crucial during U.S. concentration peaks. European markets show 18% top 10 concentration versus 35% in the U.S., while emerging markets average 22% concentration with superior growth prospects. What emerges from geographic risk analysis is that U.S. market concentration creates opportunities in overlooked international markets. Singapore's STI index trades at 12x earnings with 4.5% dividend yield, while European banks trade at 8x earnings with 6% yields, both offering superior value to U.S. megacaps. The institutional approach involves building systematic international exposure through both developed and emerging markets. Using Singapore platforms like Tiger Brokers and Moomoo, investors can access global markets that offer similar growth potential with better diversification and significantly lower concentration risk. Analyzing value stock performance during concentration peaks reveals systematic opportunities that follow predictable patterns. Financial stocks currently trade at 11x earnings with 15% ROE, while technology megacaps trade at 45x earnings with declining margins. Historical mean reversion suggests 40 to 60% relative outperformance over 2 to 3 years. Looking at sectors like energy, financials, and industrial companies, we see compelling valuations that reflect neglect rather than fundamental weakness. Chevron trades at 13x earnings with 6% dividend yield, while JP Morgan trades at 12x earnings growing book value 12% annually. The wealth multiplication strategy involves building value positions systematically during growth concentration, then rotating back to growth after concentration unwinds and valuations reset. Based on historical patterns, value outperforms growth by 5 to 8% annually during the 2 to 3 years following concentration peaks. Implementing option strategies to hedge concentration risk provides sophisticated risk management tools accessible through Singapore platforms. Selling covered calls on NVIDIA positions generates $15 to $25 per share monthly income while providing some downside protection during potential concentration unwinding. What the options market reveals about concentration risk involves analyzing implied volatility patterns across different market segments. NVIDIA options trade at 45% implied volatility versus 18% for financial stocks, creating opportunities to sell expensive premium while buying cheaper protection. The strategic approach involves using options income to fund diversification purchases, creating systematic method for reducing concentration while generating additional returns. Selling 5 NVIDIA calls monthly generates $7,500 income that can fund international ETF purchases, gradually reducing concentration risk. Understanding small cap value positioning during concentration peaks reveals one of most compelling opportunities in current markets. Russell 2000 value trades at 14x earnings versus S&P 500's 24x earnings, creating the largest valuation gap in over 2 decades with 35 to 50% relative upside potential. What emerges from analyzing small cap performance during concentration cycles is that smaller companies provide better protection during concentration unwinding because they're uncorrelated with megacap momentum. Russell 2000 value shows 0.65 correlation with SPY versus 0.95 for growth stocks. The practical implementation involves systematic small cap value accumulation while megacap concentration remains elevated. Historical data shows that small caps outperform large caps by 8 to 12% annually during the 2 to 3 years following concentration peaks, creating substantial wealth creation opportunities. Examining bond market opportunities during equity concentration reveals important portfolio balance considerations. 10-year treasuries yielding 4.2% provide attractive income while offering negative correlation to equity concentration risk during market stress periods. Looking at duration strategy during concentration periods, intermediate-term bonds often provide the best risk-return profile. They offer protection against equity concentration unwinding while maintaining reasonable sensitivity to potential rate changes under new Fed leadership. The institutional approach involves strategic bond allocation as both hedge against equity concentration and source of income during potential equity market volatility. A 30% bond allocation historically reduces portfolio volatility by 40% while providing 3 to 4% annual income. Developing systematic sector rotation strategies provides framework for navigating concentration risk while maintaining equity exposure. Healthcare trades at 16x earnings with defensive characteristics, while utilities offer 4.5% dividend yields with recession resistance. What successful rotation strategies reveal is that timing matters less than systematic implementation. Rather than trying to predict exact timing, systematic rotation based on concentration metrics provides better long-term results than attempting perfect market timing. The wealth preservation framework involves gradual sector rebalancing away from concentration risk towards sectors that benefit from economic growth without relying on megacap momentum. Target allocation: 25% financials, 20% healthcare, 15% utilities, 15% international, 25% technology. Avoiding the classic mistakes that destroy portfolios during concentration unwinding protects wealth while positioning for opportunity. The biggest destroyer of investor returns is maintaining concentration exposure while hoping that current trends will continue indefinitely. What the data reveals about failed concentration management shows consistent patterns: overconfidence in megacap momentum, failure to diversify during strength, and panic selling during concentration unwinding. Tesla investors who bought at $400 and sold at $150 exemplify emotional decision-making. The behavioral solution involves predetermined rebalancing rules that remove emotion from concentration management. Automatic diversification triggers when concentration exceeds 30% provide discipline during both euphoric and fearful market periods. Your pathway to protecting and growing wealth during potential concentration unwinding is clear and actionable. Begin systematic diversification now while megacap concentration remains elevated, building positions in RSP, international ETFs, and value sectors over the next 6 to 12 months. The wealth multiplication opportunity ahead of you is enormous because you're positioned to benefit from mean reversion while most investors remain concentrated in momentum. Every month, you delay concentration risk management costs potential opportunity when rotation begins in the next 12 to 24 months. Subscribe to Premium Logic Lab for more institutional strategies that protect wealth during market transitions. Which concentration hedge resonates most with your situation? Equal weight rebalancing, international diversification, or value rotation? Comment below with your risk management approach, and remember, the best time to diversify is when concentration feels most comfortable.